Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute for October 20th, 2013. We had ourselves a merry little time in the markets last week, didn't we? Stocks began rallying as soon as it looked like the Senate would come up with a debt bill that would pass, and kept right on going until the S&P closed over 1740, a new record, and very close to the 1750 target I've been highlighting for October all along. Unless something bad happens, we should get there on Monday or Tuesday. Momentum and technical traders will want to try for 1755 or 1760 before backing off. But all that may depend on the September jobs report that's finally going to be released on Tuesday. The chances are not bad for a rally because the market usually does finish jobs report day with a rally. If the report beats expectations, then the economy is finally recovering for about the 20th time in the last 3 years. If it's neutral, then trading programs will usually buy any dip because history favors it, and if it's weak, why, then that means more stimulus, doesn't it? So when the report is a real disappointment that things can get a bit tricky. Sometimes the market does sell off when it's weak, although more often, recently, it's taken the view that the Fed will be forced to keep providing more stimulus. Last week's rally was portrayed by the business media as bets on stimulus, and it was really more of a reflex relief trade, with the media doing the real betting that there won't be any pullback soon by the Fed, because rising markets are good for the media's business. But nobody's expecting the Fed to begin tapering this month, and the sentiment for any taper this year at all is rapidly fading anyway. So it'll be difficult for stimulus bets to surprise market to the upside. The Fed's September surprise not to taper did lead to a one-day rally, but it melted immediately starting the very next day. If you are a trader, I would certainly sell into any rally at all on Tuesday, unless it's some kind of rebound from something bad the day before, because the market is already overextended, and 2 more days of rally mode will leave it nicely set up for a fade. Earnings season is not going well. I'm sure you can find the usual propaganda somewhere that's really not that bad and, much better than expected. That's just the usual snake oil. Analysts have tried to get estimates down low enough so that the usual 2/3 of companies beat them. But when net revenue and net income gains have been as weak as they are this quarter, often negative, the initial excitement of throwing money at stocks that beat earnings per share estimates usually starts to wear off by the 3rd week of the reporting month, which is this week. We've had our Yellen announcement rally, we've had our no default rally, and all that's left now is the Fed's no taper reflex rally in about 10 days' time. Before and after that, though, the weight of weak earnings should start to weigh on prices, very likely all the way up to Thanksgiving. Now, I don't think the weakness will be anything major, not without a lot more bad news, but it should take some steam out of the market. I've seen a lot of mail and comments the last few days from people really getting excited about stocks, and that's usually a sign that prices are about to retreat again. I'm Kevin Flynn, and thanks for listening to another edition of Avalon's Market Minute.